Okay, hi. This is take two. My wife's over there laughing hard because the first time I was not able to hit the record button properly, and it went downhill fast. Okay, so this is spring term, Victor Valley College. I'm taking real estate finance, BRE 126, with Professor Regina Brown. We're using this book here, Real Estate Finance and Loan Brokering, 8th edition. So I'm trying to submit my Chapter 14 test and reflection summary, and there's a roadblock. It's being held hostage to present this video. So this is attempt number 2. The Chapter 8 covers the loan process. So the loan process, purchasing a piece of property is just a multi-step process to go through. And the loan is part of, if you take money out, is a process within the process. So the first part, the first step of obtaining a loan is filling out an application. So you fill out the application with who you are, where you earn your income, how do you make money, what assets you have, your history for the last 10 years. It's all going to go through probably Fannie Mae or Freddie Mac and sold out on the secondary market. So the government really wants to know who you are and where the wealth is so they can tax you a little bit. So we use the FHA form 1000, the Fannie Mae form 1003 to fill out the loan, and then you're going to provide not only written documentation in the loan application, but other empirical evidence that you can afford the loan. 2 years of tax returns, 2 months of pay stubs, copies of your 401k, other investments, other real estate holdings. They want to know that you are able to return a profit on this loan. So there are several options to use to obtain a loan. Some people go to their bank, some people go to their credit union. FHA, VA, USDA is a great source for farm loans. And had I not taken this class, I'd have never known that. So that may be my next avenue to buy a small gentleman's farm. So once you have it submitted, there are options out there. And usually if it's a conventional loan, it will be sold on the secondary market. And anyone who knows what happened in 2006, 7, and 8 with the collapse of subprime loans, that's why they're really being sticklers to make sure that we can pay these loans back. So the process, once you have everything submitted, all the empirical evidence submitted, the loan packet goes to underwriting. And that's where they go through it with a fine-tooth comb and ask questions like, can he pay it back? Are they really employed? What really is their credit score? What is the appraised value of the property they're purchasing? Do they have a good loan to value rate? So these are critical things that they look at. One of the questions they asked was, why am I purchasing a house here up in the high desert when my company is located down in San Diego County? And I had to provide them with evidence that where I worked was owned by the company, so that I was just at a satellite. So the goal of underwriting is to determine the financial strength of the borrower, understanding how the down payment was obtained, their ability to repay the loan, and what collateral is out there if the loan is defaulted on. Typically with loans, they want to see a 20% down payment, and anything under 20% down, someone's going to want private mortgage insurance, because there are opportunities out there to pay as low as 10%, 5%, or 3.5% through the FHA. If you do get a VA loan, the government backs the loan, so there is only a 1% funding fee. When the loan is closed, typically it's referred to as the close of escrow. When everything's signed, the deed's transferred over to the bank, you have a promissory note written, and everything comes together and the loan is funded. You get the property, the bank gets a promissory note, and everything kind of works out well in the end. So thank you so much. I appreciate it, and have a wonderful evening. And now I can move on to chapter 14.